With all the talk about pensions following the autumn budget,
how dare they?
I wanted to cover three things in this video. Firstly, how my consolidated pension has performed with Vanguard. Secondly, what I'm doing to top up my state pension. And thirdly, what I'm doing with a defined benefit scheme that's from an old employer. And then finally, what I will cover is how I expect all of these pensions to contribute to my retirement once I start to withdraw from them.
You got a pension! Huh?
If you like this video, please click on the like button. And if you're new to the channel, please subscribe and click on the notification bell and you'll be advised of the next video as it's released. So why don't we start with my Vanguard personal pension. This month marks a particularly special milestone for me, my personal pension reaching £225,000. Now, some may view this as actually quite a modest amount considering my age. They might agree.
Oh man, I'm not an old man.
But there are reasons for it. One of the reasons is I was working overseas and so I couldn't contribute into a pension at that point. And then when I returned to the UK, my salary was such that I was subject to tapered relief, so I could only contribute £10,000 per annum into a pension. Now I'm back in the UK and I've decided to take some time off from traditional work, possibly for good. And this is the first year I've been able to contribute the full pension allowance. So I've contributed £48,000 and the government will top that up to £60,000. Before we dive into my personal pension portfolio results, I want to do a quick dive into what's happened in the markets and what's driving the results that we'll see. So the last couple of months have been quite a roller coaster.
Roller coaster ride! Roller coaster!
And I plan on doing a fuller update when I do my general investment portfolio update later on this month. But in summary, several events took place in October and November, and they impacted on the stock market, inflation, interest rates. Firstly, let's touch on the Bank of England base rate change. They changed from 5% to 4.75% in November. This is largely due to inflation reducing. However, as we know, the official rates were declared at 1.7 in October compared to now 2.3. And with that, the forecasts are suggesting that the Bank of England interest rates will stay higher for longer. This takes me on to the long anticipated autumn budget where Rachel Reeves announced an increase of spending of around 70 billion annually over the next 5 years. This is largely funded by taxes and borrowing. And according to the Office of Budget Responsibility, this will temporarily boost GDP by about 0.75% in the short term. Then we're likely to see reductions in GDP after that. Also, they expect that the new budget will add inflationary pressure of about 0.5 percentage point when compared to the pre-budget forecasts. So interest rates will likely stay higher for longer, as I said. The major changes to pensions within the budget were starting from April 2027, the government wants to bring in unspent pension pots into the scope for inheritance tax. The point the government raised was they wanted pensions to stop being used for inheritance tax planning purposes. Take that as you will. If you want to know more about the impacts on your pension, then there's an excellent video covering this from Meaningful Money, and I'll put the link into the description. In addition, the normal minimum retirement age is scheduled to increase from 55 to 57 in April 2028. I expect in England, it's unlikely we'll see riots on the back of this like we did in France. Riots! But individually, what it means, it will take longer before you can access your pensions without incurring penalties. In some good news for pensioners, the government will maintain its triple lock through the current parliament. So basic state pension will increase each year by the highest of inflation, average earnings growth, or 2.5%. And in accordance with this policy, the basic state pension will rise by 4.1% from April 2025. And that will result in an increase for pensioners of around £470. So what's the general consensus? Well, it's that there will be slow growth in GDP, modest increase in 2024, potentially 2025. However, there's quite a number of economic risks at the moment, slow growth in China and in Germany, which creates economic uncertainty. These and other external factors, along with a number of geopolitical tensions, they could influence both commodity prices, but also investment sentiment and therefore stock markets. More broadly, the markets reacted well to the re-election of Donald Trump, not just to the much quoted Trump trade. Markets reacted in different ways. Certain sectors were impacted more than others, and based on the expected policies that he may introduce, particularly the automotive sector was impacted and there was a dip. The equity markets more broadly, they increased considerably on the back of the election. The S&P crossed 6,000 for the first time on November 11th and finished the month up 5.7%. You've got to remember, a post-election bounce is not that unusual. The markets look for clarity and certainty, and that's what an election, particularly an election where there's quite a sizable win, gives them. So back to the markets, the S&P 500 and the Dow Jones each saw 4 all-time highs in November, driven by the belief that the new administration's economic agenda is about pro-growth. Interestingly, equities across small companies outperformed the large caps. It could be because of the Trump rally, but it could also be because the Federal Reserve cut its base rate, and many of these smaller companies are reliant on loans and borrowing. Across the pond to Europe, well, they suffered their worst month relative to the US since about 1998. President-elect Trump announced a number of plans around imposing tariffs, particularly from Mexico, Canada and China, and that caused quite a sharp decline, particularly in automotive stocks. China announced a new economic stimulus package, and that boosted Asian markets and commodity prices.
China?
Now, you can never say for sure with the stock market, but these events, plus others, contributed to market volatility in the S&P 500 and other major indices, therefore reaching those new record highs. Close to home, the FTSE, in November, it lost ground initially on the announcements of the new president, but then reclaimed it by the end of November. Now let's move on to my pension portfolio with Vanguard. Pleased to report that my portfolio is currently running at £225,000, with an increase of £5,000 since transferring my pension over to Vanguard within the last month. Before I delve into the detail, I just want to touch on what I've been trying to do to tidy up my pensions and the strategy approach I've been adopting. Earlier this year, I decided to consolidate my personal pensions. I'll come on to my defined benefit pensions in a moment. So I decided to take a few steps at a time to do this. Before opening the account with Vanguard, I'd already transferred my oldest pension into PensionBee. I'd seen some good things about them. Their consolidation service had been rated highly, and so I felt I was in very good hands to manage that first consolidation with them. And they had a reasonable choice of funds, but their fees are a little bit high. In the meantime, I set up a pension with Vanguard where I hold my general investment account. The process was extraordinarily simple. So I requested the transfer of my latest work pension from Willis Towers Watson. Again, this was a simple process. You just follow the instructions on the Vanguard website. And finally, I transferred my remaining personal pensions from PensionBee to Vanguard. Again, straightforward process, just follow the instructions on the Vanguard website. In the meantime, I wanted to top up my pension for this tax year. As I can't carry forward any unused relief from previous years, I wanted to pay the maximum £60,000, which means contributing £48,000, and then the remaining £12,000 tax relief will receive from the HMRC. At the moment, I'm still waiting for that £12,000, but it's been less than a month, pretty much, so I'm not too worried about that.
Don't worry, not too much longer.
Just briefly explaining my strategy when it comes to pensions, I invest 100% in broad, diversified global equity funds, but not always within one fund or ETF. And of course, for some people who are close to retirement, this would be a risky strategy. But because I've got another 10 years, perhaps even 12 years before I draw from these pensions, then I'm comfortable with that risk profile. These pensions form part of my bucket 3, which is my long-term investments. And if you want to know a bit more about how I manage my investments and my withdrawal approach and asset allocation, I've linked to a video above. So at the moment I have the pension split into 3 diversified index funds or ETFs. Initially, I moved money into the FTSE Global All Cap Index Fund accumulation version, which is a well-diversified global fund which has performed really well. Then I looked across my portfolio to see if there was a way to keep things simple, but also reduce on the fees, remembering that one of the few things we have the ability to control when it comes to investing is the fees that we pay. And one of the things I saw was if I split the global fund into 2 parts, a developed world and an emerging world, and then allocated 90% to the developed world and 10% to the emerging markets, then that would create best of both worlds, which would be global, diversified, but also have a lower fee. This I did by combining 2 ETFs, the Vanguard's developed and emerging market index ETFs, and I split them 90 for the developed markets and 10 for the emerging markets. If you want to understand a bit more how I did this, then If you click on the link above, there's a video there that explains the full process. Looking at the results, now you can see that the emerging market ETF remained pretty flat since I've owned it, but the developed world ETF has performed well, and this combination performs better than the FTSE Global All World Tracker. And it's larger because of the difference in fees, where the FTSE Global All World Tracker is 0.22 when it comes to fees, and the collective portfolio of the developed and emerging markets is 0.13. Let's get to how we performed. Let's take a look at the developed market ETF. We started on the 1st of November with the investments of 184,378, and it's increased by 4,381. Looking at the emerging market ETF, we've got a decrease there. We invested 4,076 on the 11th of November, and that part of the portfolio is reduced by £13.09. Onto the all cap, we invested 19,269 on the 15th of October, so slightly earlier. That's increased by £932.71. So overall, the portfolio has increased by £5,300, which when we take the full amount that's been contributed into the pension into account, it's increased by about 2.5% in the month, which of course is very unusual.
Unusual, Captain.
But what's the next steps? Well, I'm looking forward to receiving the £12,000 from the HMRC, so I can invest that into my pension. Again, I will invest it in 90% in developed world and 10% in emerging markets. In addition to that, come April 2025, when the new tax year starts, I'll be contributing £60,000 into my personal pension. And although the modelling is not perfect, if I start with the funds I have currently and make reasonable projections with that £60,000 added on a yearly basis, and if we compound by 7% per year, it should take the personal pension pot to over £1 million. Moving on to my defined benefit scheme, which sits with Aviva. Current transfer value for this is $134,400. Now, this pension has been long abandoned. It's a defined benefit pension. It requires more steps to transfer. If the value is over £30,000, then it requires an independent financial advisor to advise you on any transfer. And that's largely because usually in these types of schemes, there's protected benefits. Therefore, at least for me, I'm going to be leaving my pension with Aviva. From that £130,000 or so, I expect to receive about £5,000 in pension when I retire. Now, that's not a huge amount if you consider that the value should be close to 4% of that transfer value, but I'm okay with that because of the protection that defined benefit scheme gives me. Finally, when it comes to state pensions, I've been looking at my national insurance contributions and seeing how full they are. Now, I had 32 out of the 35 required years to get the full state pension. And why is that? Well, as I mentioned earlier, I was 5 years overseas working. So I recently spoke to a government representative by calling the number that's on the government website when you look at your national insurance contributions, and I wanted to check how I could top those missing years up. Now, what they said to me is because I was working overseas, I would need to pay Class 2 national insurance. So I've now paid those contributions for the missing years, and now expecting then to get a quotation showing all of my national insurance contributions for every year topped up, and therefore being eligible for the full state pension. So broadly, if I take all of the different elements, all the different pensions, the defined benefit, the state pension into account, what will I receive as a pension when I reach 67? So if I take into account my personal pension, including the contributions I'm going to be making over the coming years, the defined benefit scheme and the state pension, I suspect I'll be able to draw between £50,000 and £70,000 per annum once I reach 67. Now, of course, this is subject to many different things. Market returns will impact it, changes to government policy will impact things. But either way, investing this way and having a broad understanding of what you're working towards is always useful. And in the meantime, I have a general investment account, ISAs, property and cash, and they'll bridge any time period between now and those pension withdrawals when they take place. And I'll go through updates around those investments in other videos. I covered quite a lot of ground with this video, perhaps too much, but I hope it's been useful. Maybe if, there's something in there that you can use in your own investment approach. I'd love to hear your thoughts, any questions you've got in the comments below.
Tell me.
And if you're enjoying this content, it'd be great if you could subscribe, and click on the notification bell to be advised of any future videos as they're released. Don't forget to check the links in the description below, not only to the resources I mentioned in this video, but also more broadly to the investment applications and platforms that I use. It's worth remembering that investing is a marathon, it's not a sprint. You've got to stay informed, but most importantly, stay focused on that long-term goal that you have.
He got a pension! Huh?
See you in the next video.